Good afternoon. Thanks for joining us here. Welcome to the latest installment of this conference series, Tax Reform, Perspectives from Across the Nation. Jointly sponsored by Tax Analysts and the American Bar Foundation, we've had sessions all across the country, Chicago, New York, Gainesville, Atlanta, San Diego. We're going to move to Europe in a couple of weeks and do sessions in London, Dublin, Amsterdam, and Milan. I'm Joe Thorndike. I'm going to be the moderator today. I'm a contributing editor for Tax Notes magazine and director of the Tax History Project at Tax Analysts. By way of background, Tax Analysts is the nonprofit publisher of Tax Notes magazine, as well as State Tax Notes International, other print and online products. We've been around for 40 years, or actually even closer to 50 at this point. We've been defending the public interest in a policy arena shot full of private influence. I've always liked that phrase. It's our 15th year of sponsoring public discussions, more or less, on tax practice and policy. This session is also co-sponsored by the American Bar Foundation, whose executive director, Ajay Mehrotra, is often here to be the moderator at these things. He's not here today, and in his stead, I'm going to tell you that the ABF is an independent, nonprofit research organization based in Chicago. Around since 1952, they do empirical and interdisciplinary research on law, legal institutions, and legal processes, including research on tax compliance and public finance. The ABF has partnered with Tax Analysts to help enrich our national discourse on tax policy and practice. And speaking for Tax Analysts, I can say that we are very fortunate and grateful to have the ABF as partners in this conference series. Today we're going to focus on the prospects and substance of fundamental tax reform, or what Speaker Paul Ryan likes to call historic tax reform. What makes this historic, presumably, is that it's been a long time, right? It's the distance from 1986, the last time you can make a credible case, I think, that we had fundamental tax reform of any sort. If it happens this year, it will be historic in the sense that it will be unusual. But as a historian, I'd like to offer a couple of historical comments about this ostensibly historic opportunity. One, I think, I think that public opinion is going to be a problem in this episode that we're in the middle of right now, although probably not a debilitating one. In general, Americans really like the idea of tax reform, and if you ask people in generic sense, how do you feel about tax reform, you get big numbers of people who say, yeah, I love it. But they're kind of skeptical about what the likelihood of it actually happening is, and also about whether they're going to benefit from it at all. In a Marist poll in August, just 12% of the respondents called tax reform the nation's top priority. And by comparison, 31% said healthcare, 21% jobs, 14% terrorism. Of the 7 options, it placed 5th. More troubling, Americans don't seem to be part of the, what you often hear described as the consensus for corporate tax reform. In May, a Quinnipiac poll found that 39% thought reducing the corporate rate to 15% was a good idea, while 55% thought it was a bad idea. And then not exactly a ringing endorsement, and the news just gets worse. Gallup found in April that 67% believed that corporations were not paying their fair share. A similar poll the same month from Pew Research Center found 62% bothered a lot by the idea that corporations weren't paying enough. Another 18% were bothered some. That's 80% of respondents concerned to some degree that corporations are not bearing their fair share, whatever that might mean. There is real support out there for cutting taxes on small business, whatever that might mean. Polls show, for instance, in May, 52% thought that small businesses paid too much. 63% supported a provision that would allow small business owners to pay a tax rate of 15% on pass-through income. So there's that, if you frame it correctly, and certainly that people are trying to frame it correctly to capitalize on that support. In general, I think it's probably wise to take issue with issue polls because I'm not entirely convinced that people actually know anything that they're being asked about, or certainly about what the specific proposals are out there. But I do think that what's important and what you can take from them is that these polls are broadly consistent with about 70 years of polling around corporate tax reform especially. In general, Americans have been notably enthusiastic about raising taxes on corporations and only slightly interested in using tax cuts for corporations to encourage economic growth or create jobs. In other words, these are not new issues, and I don't think any amount of political salesmanship is going to make them go away very easily. Number two, partisan unity is not all it's cracked up to be. Often when people say that they think that this is a historic opportunity for tax reform, they seem to be alluding to the political realignment of last November. For the first time in a decade, a little more, we have unified government. One party controlling the White House, both houses of Congress. And to repeat a tired cliche, like people like to say, this is how the stars align. But it's worth remembering that the last time we had fundamental tax reform, the stars were not aligned. It was a divided government, and Ronald Reagan teamed up with Dan Rostenkowski to actually make tax reform happen. So I think unified control is not the crucial linchpin that people might think it is, or the ticket to success that people might hope that it is. And I think, in fact, the struggles we've seen in the last few months among Republicans is an indication that it is not the golden ticket. When we held our first conference in this series back in April, all eyes were on the White House, which had just released a revised tax plan. And the Trump outline was noted for it was quite brief. Single page, although something like 13 fonts or something like that, I've forgotten. But in any case, it joined a policy debate that up to that point had been more or less dominated by the House of Representatives' blueprint for tax reform, the better way for tax reform. And when the administration released its plan in April, Treasury Secretary Mnuchin assured reporters that the White House and congressional Republicans were 100% in sync. And on Capitol Hill, GOP leaders said the same sort of thing. Paul Ryan said that Trump and the House were 80% in agreement, with the remaining 20% in the same ballpark. And I heard that and I thought, that's pretty good, 20%. They must be pretty close. And then I spent a day at the Smithsonian with my daughters at the Museum of Natural History, where I was reminded that human beings and domesticated cattle have an 80% overlap and just a 20% difference in their DNA. And I thought, gee, that last 20% can be kind of tricky. And the last 20% has proven to be quite tricky. In the months that we've been debating this, we've seen a number of ideas fall by the wayside, including the border adjustment tax, which is a really key part of the original blueprint, which fell away in response to a lot of business opposition and possibly the opposition of the president, although that's a little hard to pin down. We see similar division over various pay-fors that people want to use for tax reform to limit the cost of, for instance, the rate reductions for the corporate tax. I'm thinking mostly of, say, the elimination of the state and local tax deduction, or possibly what we're talking about today and yesterday, this possible limit on pre-tax contributions to retirement plans. Skeptics look at all this arguing that goes on and see it as a mortal threat to tax reform, and I think they might be right, but I think the pessimism is oversold. There's a lot of disagreement, but there is a lot of agreement too, and most recently, or most importantly, we've seen that in the form of the unified framework, which I'm sure that people are going to be talking about today, and I will say a little bit more about in a few moments. But this is the unified framework that was, that's in quotes, that was hashed out between congressional leaders and administration leaders. The current state of play here is it's actually moving quite fast. Just yesterday, the GOP leaders, both in Congress and the administration, doubled down on their promise to finish by the end of the year, pass tax reform by the end of the year. That's remarkably ambitious, I think, but still, they're hoping to do it using reconciliation, this arcane process of budget rules that make it possible to do a bunch of things, but most important, to avoid the filibuster possibilities in the Senate. It enables you to pass tax-related, budget-related, spending-related legislation with just a simple majority in the Senate. And that's good if you're planning on doing the sort of tax reform that only has single-party support. It's been done before to pass tax cuts, like in the early 2000s, and it was done around parts of the Affordable Care Act as well. But reconciliation has two significant problems, at least, probably more, actually, but two are important. One, Congress has to pass a budget before they can use it, a budget resolution. The Senate has actually done that. And it may be that by the end of this week, the House may actually pass the Senate's version of the budget resolution, which would definitely pave the way for things. But you have to have a budget resolution before you can use reconciliation, this streamlined process. Secondly, reconciliation doesn't allow for amendments in the Senate and by extension really to the legislation at all that lose money outside the 10-year budget window. There may be ways around that that would involve basically throwing out a lot of tradition about how reconciliation works or a lot of past practice. But that 10-year limit on losing money is going to be a problem, especially around the corporate tax. The Joint Committee estimated that even a 3-year sunset on a corporate tax cut will have budget ramifications outside the 10-year window. We'll lose money outside the 10-year window, so that makes it difficult. Anyway, assuming everything goes as planned and they pass the budget resolution this week, we're supposed to see some sort of tax legislation coming up in like a week after that, and we'll move to markups. And I wouldn't put much stock in any of these supposed deadlines, but there is a real rush on. Do you guys want me to briefly describe the unified framework, or are you going to all do that? All right, so I will just skip right over that. Saves everybody a little time. Before we go on, I want to remind everyone that we're recording this. That means there are cameras, and for media purposes, everything, and there are media here actually, everything is on the record. When you ask a question, and I know you're all going to ask lots of great questions, please identify yourselves just so we know who's speaking and so that people who are watching online can tell who's speaking. I want to thank the University of Southern California's Gould School of Law for hosting the event, and also to thank and introduce our panelists. Speaking first is going to be Ed Kleinbard, the Robert C. Packard Trustee Chair in Law here at USC and a fellow at the Century Foundation. Before coming to USC, Ed served as Chief of Staff for the Congressional Joint Committee on Taxation, and before that, he practiced law for 20 years in New York at, where was it? Gottlieb, okay. Next speaking is going to be Sam Melehani, a PwC tax partner here in Los Angeles, focusing on state and local taxation and especially on clients in the asset management industry. He's the Southwest Markets State and Local Tax Team Leader, working with a team of 120 or so professionals focused on the full complement of SALT services, including income, sales and use, employment taxes, unclaimed property, credits, and incentives. As an asset management client service partner, he leads a team of 50 colleagues serving a variety of large asset management companies for their compliance and consulting needs. And last on this panel, but never least, is my colleague Lee Sheppard, a contributing editor for Tax Analysts. Lee writes about everything for tax notes, including fashion and soccer. She's famous for that. But her articles tend to focus on financial issues and the taxation of multinational corporations. You can read her for her insightful commentary on treaties, transfer pricing, European tax developments, and cutting-edge financial issues around derivatives, hybrid securities, and hedge funds. So now, with that introduction, off to our panelists, who are each going to speak for a while, and then we'll take questions.
Joe, thanks very much. I'll start off. So thank you for coming. We realize that competing against the World Series is a difficult undertaking on our part. We'll try to, in fact, be more interesting. So where I want to begin is from general observations, because contrary, I think, to Joe's guarded optimism, I've come to the view that we almost certainly will snatch defeat from the jaws of victory. And I think it is perfectly possible that nothing significant gets done, certainly in 2017. And the reason I say that first is the constraint of a budget resolution, which, as Joe just explained, means that the official scorekeepers have to conclude that a tax package, which today is designed to lose money. The Senate has reserved $1.5 trillion in losses attributable to the tax bill for the 10-year period. Those losses have to just magically stop. And the bill become, the legislation become revenue neutral or positive in the so-called out years, after year 10. Now, if in fact you do that by simply turning off all of the tax provisions that are large revenue losers, well then that in turn affects your entire growth model earlier than that. So there's a fundamental issue that are raised by the budget resolution, but more important than that, Congress has more things of the greatest importance to do than it can possibly do between now and December. Just to remind everybody, we are scheduled for a government shutdown on December 15th, unless we have appropriated the revenues, the spending to keep the doors of government open. We are going to have a debt ceiling crisis in December. Debt ceiling crises are the few things that can actually affect the economy and the government of this country for generations to come. We can afford to shut the National Zoo for a week. We cannot afford to, in fact, trigger a debt ceiling crisis. We have the debate surrounding the CSR subsidies, the subsidies for the insurance companies to keep healthcare available, where there's a bipartisan proposal that's being debated. We have the whole fate of the dreamer population, where promises have been made and where legislation is urgently required. We have the fate of CHIP, the Children's Health Care Program, which is now, in effect, out of money because it hasn't been renewed. We have the entire healthcare debate more generally. And then on top of that, we have things like North Korea, Iran, NAFTA, and God only knows what else. So somehow all of that is going to happen between now and December, along with the first major tax reform bill since 1986. And I think if you think about it in those terms, you can understand my skepticism. Second point, tax reform is not the same as tax Christmas. We all know that we would rather be rich and healthy than poor and sick. We all know that we would rather have lower taxes than higher taxes, but that's not what tax reform is necessarily about. Tax reform is about a system that collects the revenues we need to make the government that we actually want function, and to do so as efficiently as possible. The finance minister to King Louis XIV said that the art of taxation is to pluck the goose with as few squawks as possible. And that observation remains true today. Tax Christmas is about empty promises and fiscal headaches when the good times are over. Third point, I think Joe mentioned something in passing that just has to be stressed, which is, on the one hand, the polls are very interesting. On the other hand, we are a know-nothing country. It is absolutely the case that the voters know almost nothing about fiscal policy and tax policy. That's very discouraging. They certainly aren't thinking about Subpart F, on their way to the market. But it is true. And in particular, what that means is that the critical truth of where the United States fits among peer countries is not appreciated, which is we are the lowest taxed large economy in the world. So we don't start with crushing tax burdens. We are, in fact, the world's greatest tax whiners, but that is not the same thing as being the most highly taxed. Fourth, we are a very large economy, and that in turn has important implications when you look at some of the abstract models for how our economy will react, for example, to corporate tax cuts. Marty Sullivan had a good piece in Tax Notes just this week, I guess, that made this point. Fifth, it is not possible to talk about the growth effects of a tax bill without talking about the deficits that are rung up, because every sensible model, including those of the Bush administration, the Bush #2 administration, did show that substantial deficits that are run in perpetuity causes their models to blow up. It does not lead to higher growth. The reason is that the deficits are not abstractions. They are, in effect, a marker of the fact that the government is required to go into the capital markets and borrow money. And as the government borrows more and more money, that raises the cost on business. And the result is lower growth, not higher growth. And therefore, what you find in many academic models, usually around page 13, is the observation that we assume that in year X, or right from the beginning, a consumption tax is imposed, or a head tax is imposed, or personal income taxes are raised. And if you think I'm making that up, read Larry Kotlikoff's column in Forbes magazine, in which he attacks Larry Summers, which is it's all very sad that these people who've been professional colleagues for years have become so bitter. But Larry Kotlikoff writes in his column about the wonders of the growth effects of the tax framework, and he says it's just not true that we're going to run big deficits because in our model we assume we're going to add a new consumption tax and raise personal income taxes. Of course, it's 4/5 of the way down his column. Finally, today in the United States of America, we are drowning in capital. Interest rates are very low. Credit is relatively easy. We are not dealing with a capital-constrained economy. And that is extremely important when you ask the question, how large will the growth effects be from a corporate tax cut? So let me quickly go through, it doesn't take long to go through the framework when it comes to corporate tax cuts or anything else. It is basically a one-page document stretched to 8. The proposal is that pass-through businesses will be taxed at 25%. Lee's going to concentrate on that topic. I have lots to say, but Lee is never for want of words, so I'll defer. The corporate tax will be reduced to 20%. Territorial tax in respect of international operations, I think most people believe, just to make the numbers work, coupled with a minimum tax, which becomes, in effect, the foreign tax rate, because there is no tax director in America who will keep her job if she can't manage her foreign tax rate down to a minimum rate. Expensing of capital investments, and then mumble, maybe something about denying or partially disallowing net interest expense. Essentially, that's it. So with that in mind, what lessons are to be drawn? Well, this has been the most extraordinary debate because ordinarily corporate tax debates go around questions like how will the minimum tax be designed? Or what should we do about sort of runaway IP that's exported and then used to finance goods that are sold back to the US? This debate has nothing to do with traditional policy in those terms. Instead, the Council of Economic Advisors, an organization which has been around for many decades and has always been very professional, has launched a publicity campaign to deliver the message that corporate tax cuts will lead to increased wages for the average worker of $4,000 to $9,000 a year. And that has set off a firestorm in the wonk world. It probably doesn't rate very highly among the shoppers at Ralph's, but within the wonk world, everybody has weighed in. Larry Summers has written very extensively about the topic. Jason Furman wrote a famous tweet storm on the subject, demonstrating to my surprise that you can make 6 points about corporate tax models via tweet. Bill Gale at Brookings has a very good column on the subject. Marty Sullivan at Tax Notes has a very good article on the subject. And all of them, frankly, are quite critical of the CEA analysis with good reason. Oh, and then Kim Klausing, who's one of the country's great experts on the question of who bears the corporate income tax, and I have a piece in Vox.com on this topic. So putting that one aside, since there's some self-interest involved, there's an awful lot of criticism of the CEA analysis. And the CEA has written just extraordinary, I thought, ad hominem responses, completely out of keeping with the character that the CEA has displayed in the past. And I am told that further rebukes from the CEA are coming tomorrow, I am told. That's the current rumor, that there'll be another broadside from the CEA of some kind. So you should stay tuned for that. What's this crazy debate all about? Well, how do we get from a corporate tax cut to increased wages for the average worker, $4,000 to $9,000 a year? That's a good question, and it turns out not to be quite so easy a story. I would suggest that the first place to start is to notice that if what you really want to do is to be fair to the evidence, you would not look to the average worker's wages, because if the most affluent Americans today triple their wages from tens of millions to hundreds of millions, that pulls up the average. But that's not what we think. What we actually mean is the median wage, the wage of the workers in the middle. And when the CEA says average wage, that is, frankly, to my reading, a signal of a lack of intellectual rigor. But the model and the story is a simple one, and the question is, how does that story map onto reality? And I would normally not bother with this were it not for the fact that this is what's been dominating the corporate tax side of things for the last couple of weeks. The idea is really, well, let me begin by making the following observation that's gotten lost in all the finger pointing. When you cut corporate taxes, that is a large, wet, sloppy kiss to old capital, to current investors, right? If we simply declare a Jubilee year and say that we are going to refund all 2016, all corporate taxes paid in 2016 as part of our Jubilee year, we wouldn't expect that to have a dramatic effect either on growth or wages. The same really is true when you, with respect to old capital, when you lower the corporate tax rate. Think of it this way. Just imagine bonds. 10% is the current interest rate. I hold a bond, I get a 10% coupon on it. I'm happy, that's the going rate for money. Interest rates suddenly, for whatever reason, decline to 7%. Now I'm extremely happy because new investors are getting a 7% return. I'm still getting a 10% return. The reduction in interest rates does not affect me, and it does not help the borrower because he's contractually committed to pay me 10%. We have to look forward, not to see any effects on behavior. The same is true here. So old capital gets a big, wet, sloppy kiss. That's just unquestionable. And it might explain why it is that so many people of enormous wealth are working so hard to raise the wages of the average Joe, if you follow the CEA story. Otherwise, it's a bit inexplicable that there's sudden concern for the working man. Looking at going forward, what's the story? Well, the story is a simple one. Again, the idea is, imagine Fredonia, a small little country. It has nothing special going on there. It has workers. It imposes it imposes an income tax. All over the world, there are other countries. Capital is mobile. Capital can move anywhere it wants. Capital moves to the best opportunity. And in this model that Jason Furman referred to as a toy model, the result is that after-tax investment, after-tax rates of return are the same anywhere in the world. If Fredonia suddenly repeals its corporate income tax in that environment, well, then all of a sudden, returns in Fredonia for a minute in time are much higher because the pre-tax rates of return on investments in Fredonia implied a corporate tax rate. Now that corporate tax rate's been lifted. By virtue of the corporate tax rate having been lifted, old capital is thrilled, new capital floods in, yay, we want to get on the bandwagon too. The first guy does, but by the time you get to guy number 12, the new capital has absorbed all of the opportunity, and by doing so has driven after-tax rates of return back down to world norms, and to the world level. The result of which is more capital investment in Fredonia, good for Fredonia, same after-tax returns to investors because there's one worldwide rate of return, but the money that's flown into Fredonia creates jobs in Fredonia, therefore the reduction in the corporate income tax in Fredonia has primarily benefited wage earners. That's the model. Makes perfect sense. The trouble is that the United States is not Fredonia. It is not a small open economy, and the model just doesn't map terribly well onto modern America. The United States is is a more complex economy. It's a partially closed economy. We still have home country bias among investors that's highly relevant here. But some of the big reasons why I don't find the story to be terribly convincing relate to some of the key assumptions in the model. The first, and perhaps the most important, is that this model assumes one rate of return, after-tax rate of return all over the world, and it's a so-called marginal rate of return. Boring, whatever, just return on your last dollar of investment. Well, in fact, many American firms in particular, think Apple, think Nike, earn supersized returns by virtue of their brand names, by virtue of the fact that I am a prisoner of the Apple ecosystem. I cannot escape if I wanted to at this point in my life. I'm not young enough to escape from Apple. That means they can charge me more. And by virtue of charging me more, they get supersized returns. And the one thing that all rational economists agree on is that the model of how corporate tax change rates translate into more wages just doesn't work when it comes to supersized returns, because supersized returns are bigger than the rate of return necessary to induce capital to be put to work, and therefore it doesn't lead to more employment. The second problem is that we know that there is a very disturbing pattern since about 1980 in which, up to 1980, productivity and wage growth grew amazingly in parallel. They were basically locked together. And then starting around 1980, that dissipated, and productivity continued to grow, but wage growth did not. And the question you have to ask yourself is, first, why is that so? And we talk about the decline of unions. There are a lot of very interesting reasons why. It's a very important question. But the CEA, in effect, assumes that increases in productivity are going to go dollar for dollar to wage earners, when the history for the last 35 years has been to the contrary. The story, finally, doesn't reflect the fact that today we have an effective tax rate of 0 or lower on many marginal investments, which is very surprising. No, we have a 35%. No, we don't. We don't have a 35% tax rate as an effective matter, as a real world matter, by virtue of expensing or accelerated depreciation and full interest deductibility. We have, and this has been documented by every Treasury Department in the last several administrations, we have negative real world effective tax rates on marginal investments in equipment in particular, which means that we are already subsidizing those investments. And finally, we have to ask the question, in the modern world, how is it we're so sure that increased capital investment, which is the idea here, corporate tax rates lead to chasing that last marginal investment, so more capital flows in, got more, as they like to say, capital deepening at the firm, so there's more capital invested behind every worker, therefore higher productivity. We not only have the question of will the worker get the benefit of that, given that it's not been true for 35 years, but are we assured that that workers will benefit at all? And it is extraordinary to me. I'm not an industrial engineer, but if you watch television at all, watch the show How It's Made, Dream Cars, and watch how a modern factory, a BMW or Porsche or Ferrari, puts a car together, and it is incredible how much is done by robots and how extraordinarily talented those robots are. If they learn tax law, I am really screwed. So the result, and finally going back to what I said at the beginning, capital is already cheap. We don't need, in a sense, a corporate tax cut to make capital cheaper in a world awash in low interest rates and capital everywhere. So with that in mind, the story, as told by CEA, is one that strikes us as highly implausible, us meaning me and my co-author. It strikes others as highly implausible. The CEA will apparently respond tomorrow, demonstrating that we're all fools and knaves. But if you think about the points that have been made, you can see why the story of why corporate tax cuts are really aimed at helping the working man is a highly implausible one. That gets to the last point, which is that the framework as constituted, Tax Policy Center did the best they could with the information given, which is very little, filled in the blanks with sensible assumptions, and concluded that the personal provisions in the framework would raise revenue, would increase taxes, but the business tax provisions, including the pass-through provisions that Lee's going to talk about, would lose $2.5 trillion or more over the next 10 years. So the entire story of the tax framework in terms of its effect on the economy is the story about these business tax cuts. And the entire story is one of debt-financed business tax cuts, which in turn is a story that is not compatible with a high-growth tax reform package. Thanks.
I'm going to stand up. You know, it's interesting. I'm listening to Ed and the list of all the things that have to happen between now and the end of December, and you can't help but get depressed about all that has to happen. So hopefully they can do it all. And as a tax practitioner, I do hope we get tax reform because we need it badly. Because that's why clients hire us. I'll tell you, you know, I spent some time. We have another client conference tomorrow, and I spent some time with some of our partners out in Washington D.C. And they think the budget resolution is going to actually pass tomorrow night. So, you know, we shall see, right? We'll see what happens. Okay, so let me take you into my world for a little bit, and that's state and local taxes. One thing you'll see about state and local, I love U.S. history. I'm an immigrant myself. I love U.S. history, and I could tell you that state and local taxation is just born with, you know, U.S. history. So there's a lot of U.S. history, rich U.S. history behind it, and I'll explain it as we go. And what's fantastic about it, you know, you heard in the intro, when I came to LA, there was only 19 of us, now 120. It's getting more and more complicated. So it's fantastic for a practitioner. I'm sure the average person out there is like, no, this is not fantastic. I have a presentation. I don't know if we can project it. If not, I'll just talk about it. So I thought I'd start with...
You can project it, but...
Do you have that presentation by any chance? No? Never mind. I'll talk about it. I can cover it.
Somebody, thanks. We'll try. I'm awfully sorry.
That's okay. No, it's fine. So let me first start talking about individual income taxation. There are a lot of concepts in here, but I'm going to try to make it as basic as I possibly can. There are really, for individuals, there are two ways to get taxed. You're either a resident of a state or you're a non-resident. If you're a resident, you're taxed on income from all sources, regardless, you know, federal, international, doesn't matter. They get to tax the entire pie as a resident. There are some states that have graduated rates, and some states have a single rate that you pay based on your total income. There are some state-federal differences, some around how you compute your income. And then a lot of states to help sort of ease the burden of double taxation. If your income is being earned from a lot of different jurisdictions, they'll give you a credit related to those double taxed items of income. So that's the basic for a resident. For non-resident, you're taxed only on your state source income, not on your total income. So that's a bit of a relief. But the computation is done in such a way that to make sure that if you have $1 of state source income, but you happen to be in the highest tax bracket from a federal perspective, they will do this computation at the state level to make sure that that dollar is taxed at the appropriate rate based on your total income. So it's not a break per se, and obviously it could wash out in a credit at the other state, your home state. Business income of an individual, if you're a partner in a partnership like myself, or sole proprietor, C corp, or any kind of a pass-through type entity that is a trade or business, you get to now move into the corporate rules for the most part and apportion income and determine that state source income. W-2 income is determined based on the location of where you are as a W-2 employee. So if I am an employee of California and I happen to go to, as a W-2 person, I go to another state, the amount of time I'm there is what I'm going to get taxed on it, on that double tax income. Some states also give you credit for as a non-resident because of reciprocity rules between them and the home state. So it gets a little bit complicated. Now, one thing I will tell you that's really interesting is if you want to go and look at California definition of which states are you eligible for credits. And it varies. A lot of times it's not without a rhyme of, there's no rhyme of reason behind it. They'll say, we'll give you credit for all these states, but we will give you a credit for the Virgin Islands. Well, that's not a state. We'll give you a credit for, Texas margins tax, perhaps, which is not a tax on an individual, tax on an entity. So it's a very random way that these credits have come around. And a lot of states, like what about Washington B&O? It's a gross receipt tax. Do I get that deduction or do I not get it as a double tax state? It's not really an income tax. It's a tax based on gross receipts. So in 2015, a U.S. Supreme Court decision came out. It's Wynn versus Maryland. I don't know if you guys have looked at it. It is a fantastic decision. It is an earth-shattering decision from my perspective. So for the longest time, individuals were taxed on sort of the due process clause. You just had to have notice that you're there and you're going to get taxed, and that was good enough. We never really went as far as applying the Commerce Clause with respect to individuals. What Wynn did is actually say there's only one Constitution, and if the Due Process Clause applies to a corporation, same with the Commerce Clause, it ought to apply for an individual too. So what happened with Wynn is Mr. Wynn, who is a very rich private equity person, paid income taxes to the state of Maryland and paid taxes to the county, income taxes at the county level. Now, he tried to take those credits for the county tax, and the state said, no, you can't take credit for a county tax. You can only take it for a state tax. So he challenged, went to the Supreme Court, financed it all the way through, and the Supreme Court agreed with him. And as a result of that, this is a big deal, because what the Supreme Court is basically saying, if you're going to tax people on all their source income, and other jurisdictions are going to tax them, whether it's a state, city, whatever, you need to give them a credit, otherwise you're going to double tax them. So it's a big deal, and he, that decision came out in 2015. It only applies in Maryland, but because it's a Supreme Court, we're starting to see a lot of states begin to react to it, voluntarily, mind you, without necessarily being challenged. California came out with a ruling in 2017 and tried to line up a rationale for when you get a credit. And they said, you know what, we'll give you a credit for city taxes if it's based on income, but so long as that tax is actually an extension of the state tax. So take, for example, New York City. New York City taxes are imposed at the city level, but nothing ever happens at the state or at the city level unless you get authorization at the state level. So it's in essence an extension of state income tax. They just choose to call it city taxes and collect it within the city budget. So the state of California did not go as far as to say whether the city is eligible or not. They just said if it's a an income tax that's an extension from the overall estate tax, and they choose to pick it up from different sources, we're going to go ahead and give you a credit on it. I think their rationale is a little bit suspect, and I'm sure there's going to be a lot of challenges down the road. But they're really, what a lot of states are trying to do is they're trying to close the floodgates and say, back off, public. I don't want you to come after me and ask for credit for every single thing you're being taxed on, whether directly or indirectly. Indiana came up voluntarily with some rules as well to try to allow, kind of deal with the Wynne decision. But you'll see typically what happens with state policy is they'll come in with a very restricted approach, and then as the challenges go on, it starts to open up the floodgates because they realize Supreme Court is just like, the decision is not restrictive, the decision is actually very broad. You cannot double tax. So query, what happens if I'm an individual resident of California and my income is taxed in London? Or maybe in another foreign country. Is that a problem? Can California give me a credit? Currently, no. They won't give you a credit because it's not a state. Well, that's still a double tax. Is that a discrimination of sorts? Is there a Commerce Clause issue? So I think those states are those days are coming ahead of us. Iowa's coming up, Kansas, Iowa changed the rules, Kansas changed the rules, Maryland, New Jersey. So a lot of states are sort of falling in line, but not everyone has done it. A lot of them are sitting quietly listening. One thing that's really fascinating about the Wynne decision, and that's why I called it an earthquake in the individual income taxation at the state level, is the dissenting opinion. If you go back to the dissenting opinion between, and it actually was joined by Scalia and Ginsburg, they both joined in that decision, which is kind of an odd group to be together in a decision. They really asked the question, who says that the state has the right to tax you on all of your income? Is that just a federal jurisdiction and not necessarily a state jurisdiction? California, do you really have the right to tax me as a resident of the state on all my income? Or should you just tax me on my California source income? If that ever becomes a reality, you can imagine what that world would look like, because you could literally live anywhere in the world and you're only going to get taxed on your state source income. So it's a phenomenal planning idea if anybody is willing to go challenge and get it up to the Supreme Court. But the dissent really, in my mind, opens up the door. We're probably, quite honestly, 10 plus years away from that. And I'm hoping to be retired by then and sit on the sideline watching and cheer for all of you. But certainly that's, I think, going to happen. We'll see. I'm kind of very optimistic in nature. So now let's go. That's it on the individual side. From a tax reform perspective, I really don't think much is going to happen on the individual side. As we talk about the corporate side here, states pick and choose what they want out of the federal law. They don't really like all the provisions. In fact, California, to sort of deal with the potential federal tax ramifications and reform, they've already have a bunch of bills ready to go to decouple from federal law. So we know that a lot of states are going to sit, or at least have a period of time where they're going to sit on the sideline and watch what happens at the federal level. So now let's go to the corporate side of the house and talk about what might happen from a tax reform. So there are sort of what I would call day-to-day issues and kind of overall environment of changing legislation and rules that are coming at us. Let's talk about day-to-day. What happens from an M&A perspective? What about international planning that a lot of companies engage in to keep that cash offshore, subpart F income, and so on? What happens to bankruptcy, insolvency, triggering 382 type issues? What do you do with distribution leverage? Are the states going to respect that? Are they going to apply different rules to it? Deferred intercompany transactions. Are they going to allow you to defer intercompany transactions, or are they going to accelerate them? A lot of states have been looking at these deferred intercompany transactions saying, I'm not so sure I like them. So, for example, an installment sale. Maybe you should accelerate it, especially if you're leaving the state. I want to accelerate. I want to tax you on it now instead of wait until you collect it when you've lost your connection to the state. Well, what about a 1031 exchange? Well, that's not a good thing. If you walk out of the state, you do a 1031 exchange, no tax. 5 years down the road, you sell that asset, can California come get it? No, we want now. We want to accelerate it now. So a lot of issues around sort of day-to-day type stuff. The legislative sort of on the horizon, you're going to repatriate all that cash to the U.S. What are the states going to do about it? I suspect they're going to be there hat in hand going, my piece, I want my part of it. What is EMP for state purposes? Different rules, different application of the laws. Interest expense limitations, a lot of states have their own limitations and may or may not apply the concepts of 163J They may look at it and say, yeah, okay, you can get it, but you have to do it on a separate company basis or on a combined basis or a unitary basis. Very different computation. Yeah, the underlying conformity to the statute is there, but you get into the calculation, very different answers. What about accounting method? Before I came down here, I was talking to one of my colleagues about this accounting method change that's taken place for financial statements. I don't know if you guys heard of it, but revenue recognition is a big deal that's taken place for a lot of our clients, and where they're looking at sort of contract by contract and looking to gross up a lot of their revenues. Because what they thought they were acting as an agent versus a principal, turns out maybe they're not so much of an agent, maybe they are truly a principal. There's a lot more risk involved. So all of a sudden now what you're gonna see beginning 1/1/18, a lot of the financial statements of our US entities are gonna just blow up. They're gonna go from, I mean, one client, just by mere adoption of this provision, they're gonna go from a Fortune 150 company to Fortune 75. Net income is exactly the same, nothing's changed, but because of gross receipts implications going up. Well, what happens at the state level? Apportionment, gross receipts tax, sales and use tax, etc., is just gonna come at you, and a lot of answers are just not to be had at this point. A lot of the states are going, oh, that's interesting. If it results in more tax, yes, I will conform, right? Because there's just really no definition per se. So what are we gonna do about all of this? You know, the one thing I thought I would sort of give you kind of a flavor for how states adopt federal law, just so we can have a starting point when all these rules come in. You've got certain states that they have what they call a rolling conformity. They will automatically adopt the Internal Revenue Code as of as of whatever today is, right? So it's always current. There's no, they immediately adopt it. And then they'll go back through legislation and say, oh, we'll decouple from this. We don't like this one. One famous thing that a lot of these states decoupled from was the bonus depreciation. They didn't like it. They said, we're not going to give you that. So that's a rolling conformity type state. Annual conformity is similar, except there's a 1-year lag. They'll wait until the next legislative session and say, okay, we'll adopt all the federal rules now. And then you've got fixed date conformity like California, which is basically, we'll adopt the Internal Revenue Code as of this date or as modified. So California adopted as of 2015 and then decoupled from a bunch of stuff. You've got some states that haven't adopted, their conformity can go back to the early 2000s. So they take their time and they really slowly consider the policy behind what the change is before they go ahead and adopt it. And you've got some states that just simply do not adopt federal. They just say, start with federal taxable income. Is that an adoption? I don't know, your guess is as good as mine. And then there are some states that simply don't have income taxes, like Ohio, Texas, and Washington. So each state kind of adopts a different model, and you're going to have to figure out, okay, which model am I in? Once you understand that framework, then you have to go back and say, okay, now what about those specific provisions? How might they apply? Because, yeah, the state may adopt the underlying statute, but how are they going to apply it in the context of their rules? And that's when it gets a little bit more challenging, because what you see on the federal level is you have this concept of consolidated federal tax returns. Federal consolidated returns is typically all affiliated companies that are controlled by more than 80%. That's a general rule. Not every state adopts that. You've got states that tax entity only, separate reporting states. You have states that have a federal consolidated return, which is similar to federal. You have some states that have combined unitary methods like California. And for those, they don't conform to the 80%, they conform to 50%. So if you have a 50% ownership, that's the first test. The next test is the unitary relationship between these entities. So if if you have a lot of different businesses and they're not interrelated, interconnected, interdependent on one another, you're not a unitary group. You don't file together as a unitary group. So you have to be an integrated enterprise before you're required to file a combined return. And it's required, not an elective. And then you've got the hybrids of combined, but you have to be consolidated. You've got a lot of sort of weird states that come at you. California is actually notoriously known for their worldwide income. They take a worldwide approach until you make certain elections. So California views the pie that they try to pick a piece of it, the world is our pie, and then we'll take a slice of it based on what they call apportionment. So what happens when it comes to apportionment? And California has a lot of different rules, so does Illinois, Minnesota, and so on. particularly what happens in the context of a unitary return, because a lot of times, we think of a consolidated return as a single taxpayer. California says it's a single pie, but ultimately the taxpayer is every single company that has nexus in our state. Well, this is a little bit different than federal concepts. So if you generate net operating losses, if you generate credits, those credits and NOLs belong to that entity that generated them in the end, rather than to the group. So if an entity is coming in and out of your group because of M&A, they could be taking their NOLs with them or taking their credits away with them. So there's a lot of traps for the unwary just in the normal application of the state law. All right, so very quickly, I'll try to compare and contrast. So for federal purposes, whenever you're trying to compute EMP, because you need EMP to determine dividends. What is dividend and what is return of capital, what is capital gains, and on and on. The concept of EMP is done through a pooling concept. Again, consolidated group, foreign income, foreign activities is all sort of considered. Foreign tax credit concept. You've got U.S. treaties that sit on top of the Internal Revenue Code. You've got Subpart F income with deemed income and so on. So now what do states do with these similar concepts? Well, first of all, states generally do not follow U.S. treaty. So whatever the treaty that the U.S. has with Australia, Japan, whatever, name the country, the states go, well, that's nice, doesn't apply. So that's problematic if you're relying on treaty as a foreign investor going, hey, I'm protected, I don't have a permanent establishment in the U.S. We go, yeah, but you have a problem in California because California does not adopt treaty at all. So that makes a big, big difference for a lot of companies. Follow federal consolidated rules. Intercompany transactions are deferred. Well, what happens if I'm a separate company state? They're only taxing one entity. Do I get to defer those transactions between me and my parent company? No, you get to tax them now. So you got to keep set of books to say, oh, for this state, I already recognize that gain, but for other states, it's still deferred. So it gets very complicated. Now you all know why I have a full-time job. Subpart F income. Subpart F income is just a concept that says we're going to deem this income to have been earned and come into the U.S. Whether you actually bring it here or not is not a relevant thing. We're going to go ahead and tax it when you deem to have earned it. States don't follow that. They go, I don't know what's subpart F income. When the cash gets here, we want to tax it. So what does that do for companies? You have to now track all of your cash distribution and contribution to make sure that when it finally comes in, you get to tax it. Otherwise, if you tax it based on subpart F income, you may be taxing it at the wrong year. So it's a timing issue for the most part. Or if you keep it offshore and never bring it into the U.S., maybe you never tax it. So very different between federal and state. U.S. connected income. You have FDAP type income, effectively connected income. Again, you may be protected from a treaty, but the states go, oh, that's nice, we don't follow those rules. And then, different treatment of intercompany transactions. So those are some of the differences between federal and state that you have to contend with when tax reform is here. I mean, you have to deal with them now, but certainly when tax reform gets here, it's just going to make life a little bit more complicated. And I'll wrap up with one final discussion, and that is around apportionment. So states are, as I said in the U.S. Constitution, they can't tax all of your income, at least at the corporate level historically. They would not tax, you couldn't tax all of your income, so they come up with this concept of apportionment. And the apportionment is this notion of you get to measure the economic activity in each state, and that ratio is what you use to take a piece of the pie to tax it in the state. Well, again, I talked about U.S. history as being enshrined in state and local taxation. In the beginning, what a lot of people relied on in the old economy was property, payroll, and sales. Those were the three measures that you looked at to say how much property I have here, how much payroll I have here, how much sales I have here. And based on that, I came up with a ratio, and that's what I would use to come up with a piece to the state. Well, in today's world, you could have your headquarters in California, your customers are predominantly in a different state, and maybe you don't need payroll because everyone is, it's being outsourced by a different company. So what do you do? And what has happened in the financial collapse that we nearly had in this country is a lot of states stood back and said, this world is changing. We have got to come up with another way to measure the economic activity, and came up with this concept of single sales factor is all we're going to care about. So we don't really care where your headquarters are. We're just going to look at your sales. And we want only your sales activities. Oh, and by the way, we are going to change our rules a little bit. historically, the way we measured sales by state is where the activity took place to earn that income. Now we're going to change it. We're going to say, where's your customer? Now think about it. Why is that important? California was complaining during the financial meltdown that we were very highly dependent on New York. The stock market, all these rich folks that live in this town were dependent on New York. And when New York wasn't doing so well, the tax revenue was going down. So you need to increase the tax base. You need to bring in more taxpayers. You need to get a lot of folks to file and pay taxes. So this notion of customer base is around the idea to segregate us or to push us away from being reliant on the East Coast in California, came up with this market-based sourcing. And essentially what it says, you earn the revenue where your customer is. So if I'm Amazon and I have all my headquarters in Washington, but I'm selling to everyone in California, it's a big economy, guess what, Amazon? You now have a factor in California, even if you never step foot in the state. So what that policy has done, is it really created a lot more taxpayers for the states. Now, query, is it constitutional? Don't know. We'll see. We'll talk about it at some point. I'm happy to debate you on it later. But certainly, I think it has created a lot of taxpayers. When I was at the Franchise Tax Board 100 years ago, there were only 400 corporate entities that filed returns in the state. Today, my understanding is well over 4,000. So a lot of companies are now filing because they found themselves with Nexus in California and with sales factor and now tax liabilities and so on. So the issues are getting more and more complicated. But again, what's really nice about my world is that it's all shades of gray. What is market? You know, if you look at it and say, okay, you assign the sales to where the market is. Well, what is a market? Well, it's defined by regulation and it changes all the time. They say, well, the market is where the individuals are located. Well, what if it's not an individual, it's a corporation, and the corporation's a conglomerate? Well, what about where you send your bills to? Okay, that's a market, you know, and so there are all these kind of iterations on what is a market, and in a lot of ways, it sort of gives you that opportunity to go, I'll keep looking until I find a better answer, right? Until something that fits better, and I can go, okay, that's a market. I like where that definition is. And then you've got a lot of other variations, you know, where that definition of where is a market. So the state and local world is getting very, very complicated, and the states are not, you know, they're not backing down, so to speak. They're looking for additional revenue. There's this reliance on the federal tax has been, you know, that cord is being cut. They were getting a lot of revenue from feds. They're not getting it as much. So of course the states are looking and hungry for cash to finance the economies. And then the same is now trickling down because a lot of the states we used to share the revenue at the local level, and now the localities are not getting as much money, so a lot of the localities are sitting back on, I need to also come up with my revenue. Now we're lucky in California that a lot of the localities cannot impose income tax, but guess what, if they could, they would. Because they need the revenue. They need a lot of taxpayers and they would come after us. So now they have the gross receipts tax, they have occupancy tax, they have property taxes, transfer taxes, and on and on. There are all these types of taxes that are, once upon a time, people will go, not material. They're becoming more and more material. Yeah?
Do you have a guess as to what the transaction costs of complying with state taxes are as a percentage of state tax revenue?
You want me to divulge my fees? Is that what you're asking? No. It is not, it's not going down, it's going up. And I would say, I mean, from a tax budget, you know, a normal company tax budget, it's about half of their overall budget just to comply.
And as a percentage of the state tax they pay overall?
Oh, you know, it could be almost 100% in some cases. I mean, I have some clients that pay 100% to comply on something that costs a lot less in taxes. But you know, it's not an option not to comply. That's another trend that we start to see with all this pressure from the state and local side, is that you need to comply with the rules. And once upon a time, a lot of companies, a lot of individuals would make a choice to say, it's $50. I'm not going to file a tax return in the state XYZ for $50. It's not worth it. Now they're complying because they don't want their name in the newspaper. They don't want someone to write about them and say, you know, you didn't pay taxes, you're, you know, messing with our laws. And you know, we talked about the old capital, right? But you know, a lot of these companies, their investors are CalPERS and CalSTRS and really institutional investors in this town. So the last thing you want is to be sitting across the board and talking about your investment results, and they ask you, are you in compliance with our state and local tax? And you say, no, I didn't file any. because it's $50. I didn't want to bother. No, they all comply because they don't want that kind of what I would call the reputational risk. So in some cases, the cost way exceeds the actual liability.
Can I ask that we hold the questions until,
Yeah.
all right? Can
I'll
we
come
all
back
hold
to
the
you.
questions?
Yeah.
Lee has not even had a chance to talk yet.
So thank you. That's all I had. I'm happy to take questions after.
Oh, goodness. I lost my voice. Those of you, who's a student out here? Students, yes. Now you understand why I tell students to go specialize in state and local when they ask what to specialize in. You will be called on every deal, usually right before the papers are signed, and you can tell them, yes, there's a New York State transfer tax on that, and watch them panic. Now, the reason states are so excited, and the reason we can do this whole little tax cut project that we've been talking about, which is going to be, it's not entirely meaningless, but you know, the United States is big. The United States does not tax a lot. The reason we can do all that is right there, that little body of water right there. You gonna tell me what that is? We're having audience participation now. You didn't know that. Come on. No. I want this little one right there. This is the Persian Gulf. This, right there. Strait of Hormuz. What's going on there? Oil is being shipped out of there. Half of the world's oil is being shipped through there every day, okay? Fifth Fleet is right here. Seventh Fleet is right here. The dollar is the world's reserve currency, and the dollar is based on oil. And that's why we're sitting here in an air-conditioned room, and that's why our deficits don't matter, and that's why we can tax federal income taxes and federal taxes on a whole of less than 20% of gross domestic product, and we can keep on doing that because half the dollars in the world are held outside of the United States, and we can create more when we want. We can create money to do lots of things, and we can use the tax code as a toy, and that's what we do with it. I mean, there's this big argument going on in Washington. Well, if we cut corporate rates, and we know that, look, our corporations don't pay a whole hell of a lot, and even though the nominal rate looks high compared to other countries, we can afford to have kind of a big wheel-spinning argument about whether that's a good idea or a bad idea or necessary, or will it have, nice effects on workers, when it will probably have no effect on workers. Mostly it affects owners of corporate shares. Owners of corporate shares are mostly not individuals. They're mostly institutions. Really, only a quarter of corporate shares are owned by well-off individuals. We'll get to the individuals in a minute. But we can afford to have this kind of discussion and we can afford to use the tax code as a toy because we have the reserve currency. This is part of the privilege of the reserve currency, besides the fact that you all came here in your own cars, fueled by gasoline that you didn't have to pay a lot of money for. I mean, imagine having to borrow dollars to buy oil because you had some other currency. That's what the rest of the world has to do. Okay, so, and I'm going to work from this big picture down to a little picture, a little picture of individual taxes and things like that. So when we started to realize we had the reserve currency, oh, come on, do this, come on, there you go, what's this? It was built around the time of World War II. Come on, you're the historian. Fort Knox. It's Fort Knox. What's in it? Maybe. Fort Knox is kind of we were on the gold standard when it was built. And what happened with the gold standard is, and this was true of all countries that had it, they kind of wafted on and off it, depending on whether they started a war or not. When they started a war, they had to waft off it because they needed to spend more. So when we were wafting off it in World War II, Franklin Delano Roosevelt, who was quite a genius about things, had that built and had some gold bars or something put in it. I mean, for all we know, it's got, bricks with gold paint on them in it, to shore up confidence in the currency. But around the same time, the central bankers realized that we had the reserve currency and they could do anything they wanted. And that the only reason you had to tax was to get people to hold the currency. You wanted to use it to measure things. You wanted to use it to deliver subsidies. You could use it to redistribute wealth. We don't, but you could. And you could use it for behavioral purposes. We're in the desert, and I don't live in the desert, and I don't, my body's not ready for it.
Both Lee and I are suffering from Santa Ana winds today.
Oh, is that what that is?
Yeah, I'm sorry.
Oh,
about that.
okay. I just thought it was dust or something. Okay, so the other thing, right around the same time, Social Security. Now, how many of you folks believe that Social Security taxes fund Social Security and that there's a trust fund for it? Come on, this is a trick question. Any of you believe that? No, we don't even fund the government with taxes, okay? This is when you have the reserve currency, you don't tax for revenue. You just push money out and you bring money in, but the one really doesn't have anything to do with the other, and what's our proof of that? What's our proof of that? What's our proof of that? Okay, that right there. Now, you were told that the House and the Senate agreed to, that are going to next week, right? They're going to agree to a budget resolution to spend $1.5 trillion on tax reform, right? That's what you were told, and they probably will agree with it. That's $1.5 trillion right there. Anybody know what that is? I think it does have its number on its tail. You can sort of see it there. It's the F-35. Yes. It's the most expensive computer with wings ever built. And sometimes when I do the longer version of this speech, I did a longer version of this speech in a state that's got a big air base in it where they're testing this thing. So we had a big, long talk about this thing because a lot of the people were familiar with it. Here's what's interesting about the way we budget. We budget cash in, cash out. So buying one of these is the same as paying a Social Security check. And, Paul Krugman tells you, right, that we're a pension fund with an army. No, we are not a pension fund with an army. We are an army with a stipend for grannies. Military spending is much larger than you think because even though this thing here is on budget, and then you hear all these, you're given all these formal budget numbers about the military budget. If it ever flies, if it ever goes to one of these countries, let's go back to these countries that were, all these countries right around, oh, come on, stop that. All these countries right around here, actually right around here, all over the place. So we've got drones bombing. Costs $1 billion a week, by the way, to bomb. That's not on budget. Overseas continuing operations, not on budget. Military budget is it's about half again as much, twice as much as is formally recorded in the budget because of the stuff that isn't in the formal budget. So when the newspapers are telling you, oh, heavens to Betsy, we have to panic about the formal deficit, and we can't go bankrupt in our own currency. What they're talking about is not even measured properly. So let's go down to the micro here. So we're having kind of this wheel spinning argument here about small numbers, really, for the income tax. And we're, as we've been talking about here, and as is being debated in the newspapers, we're making policy based on numbers And we shouldn't be doing that, because what we're doing with the income tax, while we're using it as a toy, we're making a bunch of value judgments. We're using, really, we're using this as a way to communicate with individuals about what the government would like them to do and what things the government approves, and what's good citizenship. Good citizenship is getting married and getting a mortgage and things like that. We're making value judgments, and you cannot make tax policy purely based on numbers. But as Ed will attest, over our lifetimes, tax policy has been made more and more and more on a set of numbers. And all these numbers, whether they're, because what he was talking about is there's competing sets of numbers. There's Joint Committee numbers, CBO numbers, right? CEA numbers, Treasury Office of Tax Analysis numbers, just numbers all over the place. But all those numbers were supposed to do was kind of help you out with the value judgment, Are we going to push money out into the economy because we're going to subsidize, taking title to your own house? Or are we going to tell people we'd like them to save themselves for retirement because they don't have any pensions anymore, so we're going to push money out for that? These are value judgments, and you cannot, make those, you cannot make everything on the numbers. And this is what the folks who are drafting the tax plan, because it's being drafted, and supposedly next week we're going to get a slug of draft, like, several hundred pages of draft tax law. These folks are going to find this out the hard way, and they're going to find it out on the individual side, because the way the numbers work out, because they're all constrained by the numbers, even though, when we look at that world map, we know we can't go bankrupt in our own currency. They have constrained themselves by the numbers. All these budget laws that Congress made, those are self-imposed. It's not like it's a state constitution with a balanced budget requirement and the state doesn't have its own currency. And this state very nearly, by the way, did have its own currency when there was a fiscal crisis and they were getting ready to issue scrip. You can't make policy based on these numbers, but they're going to find it out the hard way, because not just because things that they're suggesting for individuals are very unpopular, but also because they came up with an idea. If we go back to the history of this idea, this corporate rate cut, which the companies have been asking for years, okay? I mean, those of us who deal with Washington for years and years and years, companies have been whining about this, even though they hardly pay any taxes. Because the corporate income tax pulls in about $370 billion a year, and then about a third again as much is subsidies. The corporate income tax has a very high subsidy component. It's a subsidy delivery mechanism with a tax attached, basically. Because of that, if you have to go to lower the rate, you got to claw back all the subsidies, and then you got to start clawing subsidies out of the individual side, because all these subsidies in here, this is a bundle right in here. This tax one, this is $160 billion or so a year. All of these lines, every line on that page there is about $20 billion a year. But because that corporate income tax has such a high subsidy component, that, cutting the corporate rate to where they want to cut it costs you somewhere in the vicinity of $3 trillion in 10 years and $7 trillion in 20 years. So really, it's sort of doubling the subsidy component of the corporate income tax. And so then they start saying to themselves, and this is what you saw in the Camp draft. I don't know if any of you practitioners ever looked at that, but you want to be looking at that because they're using that as a template for the stuff they're drafting. So if you want to get a jump on it, look at that. But also, if you've got clients in particular industries or with particular subsidies. You want to look at what does the camp draft do to this group of clients because they are mining that thing for ideas. And what the camp draft was on the whole, it was, well, what are we going to do to pay for a corporate income tax cut? And where are we going to whack the blue states? And you look at it and say, well, these are red state Republicans. They want to whack the blue states, and some of them do, okay? But the other problem they're running up against, and this is, well, let's move into the individual, is who's paying the individual taxes? Folks remember that, oh my goodness, I'm running out of time already. Okay, folks remember that, all right, fine. Folks remember that George W. Bush presided over, and Congress had to agree to them, a lot of tax cuts, okay? Those tax cuts knocked a lot of people out of the income tax entirely. When they expired in 10 years, because they were done kind of the same way that we're proposing to do them now, the Obama administration had a chance to undo them, to unspool all this. Why didn't they do it? Anybody got a socioeconomic blue state explanation for why they might not have done that? If you unspooled those things, you might put some people who weren't in the income tax back into it. But the other thing you would do is you would raise taxes on high-salaried people, many of which lived in blue states. Because now when we look at it and we say, well, we have to have a middle-class tax cut. Taxes are not the middle class's biggest problem by a long stretch. But the other thing you find is when you start looking at the distribution of the income taxes and who's paying what, you find out that what we could consider the actual middle class, because there's a big argument, and that's part of what was the argument in that Tax Policy Center paper. There's a big argument about who's middle class, okay? Because a lot of folks here, and where I live in New York, would say, oh, well, you know, $200,000, $300,000, $400,000, $500,000, that's middle class. That's, kids, that is not middle class, okay? But that's the folks who's paying the taxes. When you look at how the tax burden is distributed, and we shouldn't talk about burdens really, but when you look at the distribution, you find a very large chunk of tax filers, almost somewhere in the neighborhood of 40%, and this is the same folks that Mitt Romney was talking about when he was talking about 47% not paying, and he was talking about that not realizing that that had been George Bush's policy. You had a big chunk of the filers who don't owe anything in income taxes. They pay substantial amounts of employment taxes, but they don't pay income taxes. They do file, they get it all back, and they like that big refund. And you say, well, if you want to put more money in their pockets, why don't you just not withhold as much on them, what I thought. But they like that refund, and we make them file this thing, which is completely unnecessary. They don't file this. They don't itemize. We make them file a tax return because this is how we communicate with citizens. This is how we spend. Then you got another group, which we will call the real middle class, and these are people who have they've got incomes of like less than usually $100,000. They have a positive income tax liability. It's not very large. It's really, really small. It's somewhere around 4 or 7%. And their employment tax liability can be almost twice as much. Those are the real middle class folks. It's actually very difficult to cut their taxes because they're not paying a whole lot. So what are you gonna do? You know, it's like they're paying $4,000 in taxes on $100,000 or something like that. And you're gonna say, well, we'll get you a new bag of groceries every week. You know, how are you gonna get them excited about that? Then you get a group of high salaried people, and these are the people around, you know, you start at around 100 and then you go up to, you know, you go up to where you're into the 1%. The 1% start at 400,000. So the 1% are actually a pretty, what's going on here? I'm standing too close to speakers. The 1% are actually a pretty big group too, and they're kind of diverse. You have this high salaried group, okay? They itemize. They tend to live in blue states. I mean, when we went and oh, stop binging at me. When we went and tanked the economy in the middle of the country, right? We ended up with wealth here and a little bit of it in Illinois here and some in Texas here. And we ended up with a situation where the itemizers, this is the schedule here, we ended up with a situation where all the itemizers are mostly on the coasts and they're mostly high-income people. They're taking the state and local tax deductions, all of those state and local tax deductions that you see there. They're taking mortgage, very few people take mortgage interest deductions. Even though people just cling to that idea, they're taking the mortgage interest deductions. They're also the ones with big contributions to 401k plans. So when you start thinking about cutting those things, and I don't think mortgage interest is off the table, really, because that's one we've gone back and forth on for 30 years. 401k contributions were cut in 1986. In 1986, you could put $30,000 in those things. We still haven't gotten back up to that with the inflation adjustments. For years and years and years and years and years, not just red state Republicans, but economists too have said, oh no, you really shouldn't have a deduction for state and local taxes. And that one's being fought quite vigorously. The betting is that nothing will be done to that. Nothing will be done to cut 401k contributions. But then when you start doing that, then you start losing your numbers. The other thing that's going to happen is there will be a fourth rate. There will have to be to make the numbers, because this is how obsessed we are with numbers. We're backing out policy to get to numbers. You know, there were people that wanted to cut the top individual rate. It's unlikely to get cut. And so then what happens is you get the same group of people paying the bulk of the taxes, and the same group of people paying the bulk of the taxes are going to be these high salaried people. We haven't talked about that fourth group of people, and that would be really, strictly speaking, it's the 0.1%, but it's also big chunks of the 1%. There are folks in there who live off wealth, okay? They are probably not going to get a capital gains cut. The reason they're not going to get that is because, unlike the situation in, 30 years ago, we know a lot more about the composition of the $1 million plus filers. And so policymakers are now looking at them and saying, well, who's deserving and who's not deserving? And they have come to the conclusion, and we're going to segue into our partnerships with this, that hedge fund managers are not deserving, and that law firm partners are not deserving, but that people who have closely held businesses in other things in partnership form are deserving. Because you get a whole variety of folks in these higher brackets. So when we move over to partnerships, and I've skipped over. The other thing that might happen in individual while we're at it is that if they lose the fight on some of these big things, then they'll just go to a straight-up cap on itemized deductions, which is interesting because that and the standard deduction increase are both New York ideas. New York has a huge standard deduction, and in New York, if you're at a certain very high level of income, you get no deductions whatsoever. You're just taxed on gross income. So you might see something like that. When we move over to these 1%ers and these 0.1%ers, and we start segregating them from each other, we see that a lot of them are partners in partnerships. And that what we've got with partnerships, when we allowed limited liability companies and when we allowed corporations to be partnerships, you've got a very privileged class of taxpayers in partnerships. Partners are a privileged class, and partnership investors are a privileged class, because even though folks who like to argue about these things are saying, well, what's the justification for having a special 25% rate on the business income of partnerships? Well, you know what they're paying now? We have the numbers. Some people analyzed the Treasury numbers on this stuff. 16% across the board on partnership income. It is not being taxed at the highest individual rate as the mythology goes. If it's a finance or real estate partnership, it's 15%. So you're really not changing the rate much from what folks are actually paying when you go to lower this rate. But when you go to lower this rate, you get all kinds of fun and interesting complications. And this is another billable time gold mine here. You're gonna have to segment partnerships into different buckets. So the first cut is gonna be, well, 25% is for retained business income, okay? That means can't be distributed to partners, okay? It also means investment partnerships are not eligible. Well, that's a big chunk of partnerships right there, okay? So you hive them off, and they're in their own universe. Then you say, well, okay, I have a partnership. It's got a business in it that's not, investing. It might be a real estate business. Real estate partnerships will be eligible. And how do we know all this? We know all this from previous drafts. We know this from the Camp draft. We know this from the House Republican blueprint. We know this from things that the president has proposed. What we're doing is we're filling in the blanks in the 9-pager with stuff we know from previous drafts. First, we take out investment partnerships. Then when we're looking at a partnership with a business in it, we say, well, who's a service partner here? There's going to be deemed salary. And the deemed salary component is going to be pretty high because in the Camp draft, they put a formula in there for it, and that was 70%. So you're going to take all your service partners, and you're going to say, of the partnership's gross income, you guys are deemed to have paid yourself salary of this much, and it's going to be taxed at the highest individual rate. Then, and you say, well, how can we do this? We've already got the definitions of this stuff in the law, because we've got a whole bunch of self-employment taxes, and then we've also got that special tax for investment managers. So we've got a bunch of definitions of who's an investment manager, and we've got a bunch of definitions of who's a service partner already in the law that we can use. Then you're going to say, well, okay, what about those profits interests of those hedge fund managers that we've been hearing so much about in campaigns? Well, that's going to happen too. And so you're going to have rules that say, well, if you've got a partnership that's subject to both sets of rules, and it would have to be a real estate one, because that would be the only type of partnership that would be eligible for the lower rate, have a deemed salary issue, and have issued profits interests itself. There will have to be an ordering rule for those things. And so what all does this get you to in partnership land besides an enormous amount of complexity? What it gets you to is that you're going to have to make a whole bunch of decisions at the level of the partnership, just like we're seeing in the audit rules. And eventually, entity level of taxation of partnerships will be quite feasible. Because we're the only country that doesn't do it. Even a lot of states do it. Partnerships are very complex to run. And people run them in the United States because it saves them a whole lot of tax, even though it costs them a whole lot of money to hire guys like our friend here. But they don't. But in other countries, there's way fewer partnerships because they're taxed at the entity level, and people have them only because they really want to have them. And I will shut up now, and we can have questions or, heckle, throw things, whatever you want. Thank you.
Thanks very much, Lee.
question? Yeah.
Okay, so,
Can you identify yourself before you?
yeah, I'm John Gordon, I'm an attorney, a corporate attorney, specializing in a lot of international cross-border transactions. I'm a graduate of USC Law School as well.
Yay.
There's a lot to unpack from what you spoke about, and you all spoke very, very well on a number of issues. But the big takeaway of what's going on here is that this idea of tax reform is a solution looking for a problem, in search of a problem. I mean, our economy, from most measures, seems to be doing quite well. California, one of the highest tax, most regulated states, is doing quite well. So at the end of the day, this is all about politics. And you alluded to it.
I was
with the
hoping to
idea
be
of
more than alluding, but.
Alluding, well, you alluded to it, you said it explicitly that it's really getting at the blue states. And we know the Trump administration, from what we see, is only interested in getting reelected and only interested in the populist mandate. So knowing that, don't we know exactly what's going to happen?
Well,
Can I? Oh, sorry.
well, okay. Well, when there's getting at the blue states and there's not getting at the blue states, but because there's the implicit getting at the blue states and the explicit. Okay, if you ask, there are some Republicans in Washington. If you say to them, "Well, why should we repeal the state and local income tax?" they will flat out say, "Because, we shouldn't be subsidizing the blue states," and that's also. In order to feel that way, you have to believe that there's a limited number of dollars and that the deficit matters and things like that. And a lot of those guys believe that, and a lot of Democrats believe that too. Because the Democrats became a balanced budget party, and that did not do folks in the middle a lot of good either. So yeah, there's the explicit, but then there's also the implicit, because your implicit problem here, and the camp drafts that we're talking about, those were written between 2011 and 2014. Okay, they found out basically when they looked at all the numbers. This is where the taxes are being paid. I mean, there's a thing in there about marking derivatives to market. Well, that's a New York issue, basically. There's a whole bunch of implicit nailing the blue states too. But then when you want to tag it to the election, you can and you can't, because electorally there is no such thing as a blue state. There are red states with blue cities in them, and the question in every one of those states is the city vote big enough to overwhelm the state vote, the outside of the city vote?
So I take a different view. It's a great question, but I think the red state, blue state setup is false. I think it's a distraction. Yes, it's true, we can couch the possible non-deductibility of state and local taxes in those terms, but what this is really about, it's purely political, but it's much more focused and targeted than that. This is and has been the #1 deliverable of the Republican Party, because it is what their donor class demands. And the donor class wants more for themselves. And I'm sorry to speak in such blunt terms, and I'm sorry to make it sound quite so political, but that's the only explanation for the reason you said. As a reform gesture, this is a bad joke. As a payback to the donor class, well, it kind of makes sense. And if you ask yourself, what would you do if this were a reform agenda? Well, you dig out Camp 2014, and you'd see which is a very serious Republican work product, and you'd see what tweaks you could make to it, to update it and to deal with pressure points. And yet we're not doing anything of the kind. Let me just, because you're interested in international, I just want to make one really quick observation, which is I do believe that we're going to go to a territorial tax system. I'm very confident it'll be coupled with a minimum tax. And the question will be, is that minimum tax country by country or global in its effect? Big difference. Country by country is much stricter. But what's also going to be interesting, of course, is what is the minimum tax rate, because that's what foreign taxes will be managed to. And when you remember the extraordinary success of many of the best American companies that engage in what I call stateless income tax engineering are way down at single digits today in their effective tax rates. It is entirely possible that some of the most successful international tax gamers among corporate America today will find that their tax bills are going up, not down, when they move to this territorial tax by virtue of even a modest minimum tax.
But it will be billable time in the meantime. It will be very complicated.
Yes, I'm sorry. From your point of view, this is fantastic.
It's wonderful. You want that minimum tax. It's good policy, really it is.
I got a follow-up question, which is actually at the state level for Sam there. Given everything in your response, Kansas was a very interesting experiment. And that was a state and local issue, and you have the cities battling against the state, against the governor's idea to reward the donor class, and it was a disaster. But that's talking about history, and no one wants to learn about the problems of tax reform on the Kansas model because it's a disaster. And so what's your view about our federal government following the Kansas model when everybody knows that that was an experiment that didn't work?
Well, Governor Brownback's view is we should have kept running it indefinitely until it worked. But let me just finish. In the little piece that Professor Kim Kosing and I did for Vox.com, we looked at what we thought was an even apter analogy, which was corporate tax rates and wage growth in the United States versus the UK. Because as you know, for the last 10 plus years, the UK has been engaged in a step-by-step, very deliberate program to make itself competitive, to reduce its corporate tax rate. And so we had lower tax rates in the UK in a very stable way, not unpredictable, erratic government like we have. And of course, the result was lower wages, not higher wages. And does that prove that raising the corporate tax rate would lead to higher wages? No. Does it prove that lower taxes lead to lower wages? No. It proves that life is just much more complicated than these toy models, to use Jason Furman's term, than these toy models reveal. Kansas, based on a toy model, disaster. The UK experience has not been good for wages. You could argue that, well, if it weren't for this, wages would have been even worse. Maybe. But the fact is that what we do for a living, whether it's in practice or in policy, because I've been on both sides of it, is like studying the mating habits of butterflies along the side of a highway. And just when we think we've got the dance figured out, a tractor trailer comes by and blows those butterflies all over the place, and we have no idea how to interpret that. That's the reality of economic life.
I think that's revenue estimating. No, Kansas was a narrower experiment than folks here appreciate, because what it was about also is, if you know about the geography of the place, Kansas City straddles two borders. It was really about poaching business from the other side of the border, from the Missouri side of the border, and who knows whether it succeeded in that or not. But in the meantime, Kansas doesn't have its own currency. And so when you're taxing in somebody else's currency, which is dollars, and you have to balance your budget, then you have to cut schools and things to reward the business class, and people don't really go for that. Even if the poaching temporarily worked. I mean, Ed used to live in New York. I live in New York. We're experts on state, poaching from others. But when, and Sam should talk about this, when states went to forced combination, because it's now, 37 states are in forced combination now? When they all went to forced combination, and when the northeastern states went to forced combination, some of that poaching, got a little bit reduced. You have to poach according to property taxes now, I think.
So let me, without really bashing California, anybody else for that matter, I'm just going to tell you some facts, and then you can judge for yourself, right? I think we all have different opinions about whether this is good or bad. We put together a list of all the companies that have left California in the last 5 years. It's approximately 250 companies that have relocated outside the state and moved to states like Texas because of the lower tax burden. So is that a good policy? Is that a bad policy? I don't know. I mean, that's something we need to decide. What's the long-term economic effect? I mean, you look at cities like Torrance, Toyota leaves, that is a lot of families that have been detached from that location, separated from their families, bless you, moved completely out of town and relocated because they decided Texas is a better place. So that is a real economic impact on the economy. And who's replacing and who's coming into the state is a lot of the asset managers. The folks that really don't care where you live. They have the wherewithal, they can live anywhere. So it's not a big deal. So you become kind of a commuter type state. Now, the other thing too is if you go back to California, California publishes all their tax details. I've looked at this about 5 years ago, so I apologize, my numbers are a little bit behind. 38 million people in California. 400,000 of them pay 90% of the tax. That's less than 1%.
Oh, of the individual?
Now, 37,000 of those people pay 50% of the income tax. So there is a bunch of people that just don't pay any income taxes. And we continue to go down the road of raising income tax. And at some point, you're going to say, what's the breakage point? I was at a presentation with the mayor of LA, and he said, there's so much people are willing to pay for great weather and fantastic golf, opportunity. At some point, there's a breakage point, and people say, you know what, I'm going to go live somewhere else, and I'll drive in. I'll commute in, I'll fly in because I can afford it. And I think that's the problem at the state level is that, yes, there is a policy of we have a great government, big government, lots to do, lots of programs and so on, but it comes at a cost, and that cost, there's a breakage point. I don't know when that breakage point would be. In the 70s, we got near it, but now I don't know if we're near it. I think maybe there is a lot more opportunity to tax and spend more, but I think at some point, something has to give.
That's thought-provoking. Where do subsidies that states compete on for bringing in businesses fit within?
They do it with property taxes now.
Because that's a big thing. I mean, Amazon's doing that now, but it's not very transparent. I don't
No.
know if there's been much empirical research done on this.
There's been a lot of empirical research
Yeah.
done.
States keep it very
Actually.
quiet. Politicians keep very quiet. What's really going on out there when
Let me
states are
do the
giving
empirical
something
side first.
out of their pockets that they're supposed to be taking in by getting 200 taxes? No one really knows.
There is a lot of empirical research. This is one of these rare questions where to which there's answers that seem pretty credible, even though they were prepared by economists. And what the research, I think, pretty much all points to is that it's money badly spent by governments. That it's just that they don't get the bang for the buck for the extraordinary subsidies that are being made, the Tesla battery factory or whatever.
Yeah, and, this was challenged, and this is sort of a query to the group. This is a law group, so I will just leave it in front of you. I'm not an attorney. If you were to ever challenge these subsidies, would they pass constitutional muster? Because they certainly are incentivizing one state over another, right? I mean, that's by its nature. And Ralph Nader tried to sue Illinois or Alabama, I can't remember now which state, related to some factory. And he went to the Supreme Court, and Supreme Court punted. They said, you don't have standing. So, yes, there's a real question. Do these things really pay back what they intended to do? Do they create the economic opportunity that we think it's going to create? It's a very good question. I think some jurisdictions are far better than others in executing. Because a lot of times, if the credit, there are two types, we always describe them as credits and incentives. If the program is meant to reward you for an activity you are about to take, I think that's very effective. But if it's a program to reward you for an activity you undertook already, you moved, you did everything, is that really, what's the benefit there? I already moved all my people, I already built the factories, I did everything, and now I'm getting that break. Why am I getting that incentive? So I don't know that necessarily they're a bad thing. I think they can be executed appropriately and more scrutiny around them and really design them to do certain things. A lot of them too are very much behind old type of economy. They're not incentivizing sort of the innovation type stuff. We want the manufacturing, we want the factories, we want the jobs. where if you come in, some companies are spending significant amount of capital with not necessarily creating direct jobs, but a lot of the economic effects. So I think a lot of them need to be modernized and need to be more effective in their application rather than a reward for something that's already been done.
So just point out that as you all know, I think, in the EU, these kinds of subsidies are illegal. And that's the whole gravamen of the complaint against Apple, that Apple and Ireland essentially conspired to deliver these kinds of subsidies through the income tax system. Now, I just want to remind everybody that we'll stay as long as you want answering questions. But on the other hand, there's alcohol and hors d'oeuvres upstairs in the reception. And so you all have to make a choice what it is that you want. Do we have questions? I think, Joe, would
We're
you?
done with questions? Time to move to the alcohol?
I unfortunately cannot stay. I have a family event that I have to attend, so I apologize, but thank
All
you
right.
for
Thanks for
having
coming.
me today. Absolutely.
Thank you.
My pleasure.
You have to stick your hand up. It's teasing.